kid and had to figure out how to make a living. So I started reading books, and I learned about the idea of asset ownership and passive revenue, and so I'll explain a little bit more about that. But my kind of trajectory towards real estate was all about how do you build an asset base that enables you to do the things that you really care about and that you're really passionate about in life. So we've got a few projects that we started here in Edmonton. Most of our work in the city is oriented towards social enterprise, community development, and sustainability. And the real estate work we've done has been a kind of a hedge against all this crazy other stuff. So I'll give you a bit of the context. One of our companies is called Sustainable. This is the world's first green carnival. It's a full-scale carnival with Midway that runs entirely on renewable energy, and we produce events for 20 to 50,000 people. It's like a not-for-profit educational platform to teach about energy literacy. This is the stuff that some real estate investors do on their stuff on the side. This is another company we founded called Sustainatech. We build high-density lettuce farms, commercial lettuce farms with shipping containers, and this thing's going crazy. We've got to build 100 of these in the next 2 years. And then, so we were doing all this stuff, and now by this time, I moved back to Canada in 2007, and 2011 we really started to get into commercial property. We were doing residential before, and I just, we had all this work happening, and these are very risky ventures, right? Carnival companies, it's not the most obvious place to make a living, and a tech startup like this also is at the outset likely to fail most of the time, right? Most of these companies don't make it to full term. This one's doing really well, but I didn't know that at the time. So I figured I need to hedge my bets. And so because these are all really exciting projects, so I was like, we got to do something boring. We have to kind of benefit from all the learning we've done over the last 10 years around real estate. So we started a company called Boring Investments. And we just started buying stuff. And I had done a lot of consulting work with large developers, and so I had quite a bit of experience, especially through 2008 and 2009. It was a really, who's here during that period? Yeah, okay. Who of you who actually got to see some crashing and burning happening close up? Okay, so some of you, right? So I'll talk a little bit more about that later. But 2008, 2009 was a very educational period for anybody who's doing anything in real estate. And so because I had the experience, I knew what I was talking about. So I was able to mobilize partnerships. I was able to go out and explain, this is what we want to do. We want to buy an apartment building. Our first project was an apartment building. And I knew what I was doing. I was really confident, and I was able to mobilize $500,000 to do our first deal. And then it's like once you do one and you do it really well, then there's momentum, and it becomes easier and easier to put projects together. So that was up to 2015. Last year we rebranded as Sparrow Capital. Boring Investments was, my bankers love that name. The bankers love it. My inner circle loved it. It's not a great forward-facing brand. So we rebranded as Sparrow Capital. Sparrow also is kind of like communicating the idea of collaboration, because we've built a kind of culture that's an open, transparent, cooperative way of putting these assets together, and it's kind of unique. So I think of assets like it's kind of like planting an apple tree, right? You put a seed in the ground, you grow a tree. Every year there's some fruit. Every year the tree grows a bit bigger, so every year there's a little bit more fruit, right? And then at a certain point, the tree gets big enough. I'm sure the analogy breaks down, but you kind of chop the tree in half and make two trees, and then they both grow. That's how we approach commercial real estate. So who here is familiar with Thomas Piketty? Okay, so you probably don't want to read his book because it's really nerdy, but you might. So Piketty is a French economist. He took this research that was done in the 50s by a famous economist named Simon Kuznets. And Kuznets did a study of wealth in the United States. And he took the extensive tax record database that was available at the time, and he studied, from as far back as they could in the United States, how much wealth is controlled by what percentage of the population. And it was a really optimistic study, because if you look here around 1955, this is the end of the 19th century, so this is the Gilded Age. This is a period of extremely high inequality, wealth and income inequality. But then you have the Depression and the World Wars, and you have this massive industrial expansion, and you have the huge infrastructure development, highways being built all over the country, population growing rapidly. So there's a ton of economic growth. And by 1955, this is what Kuznets is looking at. He's saying, wow, this is wonderful. We're on this great trajectory. Everything we're doing is resulting in more and more balanced distribution of wealth and income through our population. So that's a great thing. So this is like a really encouraging, we're on the right path, right? That was the signal here. Now, this is where we're at. So Piketty and his team, the reason his book caused shockwaves through the economics world is because they did a 15-year study, and they published all of their data. And it's all online. You can go in and you can look it and you can parse it, and there's all kinds of amazing debates and conversations that are happening all over the world in academic circles around this data. And so they expanded on the US, so they took Kuznets' research, expanded it out to 2010, and then they also did Britain, France, India, and Brazil, which were 4 other countries that had extensive historic tax records. And so this is what they're finding across all the, oh, in Australia too. All they're finding is that we're getting back to a place of high inequality. And we're seeing this in the news, we're seeing this in our politics. We're seeing it in impacts on labor demand and job security. So this is an issue. And this issue is only probably going to increase as automation and AI start to become deployed. But that's not the topic of tonight's talk. So this is incomes. Right, so this is showing in 1910, 22% of this is the top percentile. Okay, so the top 1% of the population earned 22% of the income in 1910, and in 1970 it was around here, around less than 10%. Right? Now we're back up to in the teens, the high teens. This is wealth. So this is a map of who owns the wealth, right? So this is the top decile. That's right. So in 1810, so here, let's go to Gilded Ages right here. So 1890, something like 6%, 60%, 60, 70% of the wealth was controlled by the top 10% of the population, and now we're back up to something like 65%. So this is important because, you know, the lesson I learned when I started 15 years ago, I'm a monk, I have no diploma, I have no real job history, you know, it was my CV is like, oh, I used to, you know, meditate. But, so, you know, early on I got this lesson that if you own assets, assets can generate revenue. And if you don't own assets, then to earn income, you need to you need to sell your time, you need to sell your labor, right? And I realized that to do what I want to do with my time in my life, it will be useful to have assets. And this is kind of like the dirty secret of capitalism, right? I often say that the biggest problem with capitalism in terms of equality and social dynamics is that there's not enough capitalists because too few people actually learn this lesson. First of all, I should have assets. Second of all, how to acquire them and how to operate them and how to mitigate risk, right? We don't learn that properly. So that's kind of what we're talking about. So Piketty's conclusion is R is bigger than G. So his whole big heady book is distilled down into this tiny little sutra, R is bigger than G, and that is that the average rate of return on capital tends to be greater over time than the annual growth rate of the economy as a measure of income. So the total income in an economy, all the earnings of all the people grows as the economy grows, but the return on capital tends to exceed that. So if you, and that's easy, that's pretty intuitive if you think about it, right? If you have $1 million of assets and you're earning, you know, 10% on that, that's $100,000 of income without having to work. So you could have a job and you could have $100,000 of income from your assets, and you could just park that $100,000 and invest it and still live the lifestyle that the person who's working has a 6-figure salary has. And so that money now is going to grow, and then the profits from that can be planted and that can grow. So you can keep accumulating wealth. If you have a $500,000 income, you can save 80% of your income and still live a good life, right? Or if you have $1 million of income, if you think about that, you could live the most extravagant lifestyle and still save 50% of your income. But if all you earn is $100,000, saving 20% is a real challenge, right? So over time, the revenues that accrue from the money that you're able to put aside from your various income streams will eventually exceed the money that you can earn by trading your time for money. Does that make sense? Mm-hmm. Yeah, okay. So R is bigger than G. Tends to be. It wasn't in the 50s, but now it is. So apple trees. So this is a typical asset. in our portfolio. There's a building actually just around the corner from here. And I'll talk a little bit more about this particular deal, because this is a good example of the particular dynamics of commercial real estate specifically. Commercial real estate has certain advantages and disadvantages, and that's kind of the main thing I want to communicate tonight. And if we have time, I'll speak about some crazy pie in the sky ideas at the end of it. We'll see if we get there. All right, so a commercial asset like this building, it doesn't produce apples, it produces income in 3 different primary categories, right? So cash flow is the first one. So you've got your tenants are paying rent at the end of every year, you've got money in your bank account, that's money in your pocket, right? So cash flow is really important. It's not only important because it's an income stream, it's important because cash flow is what protects your asset from volatility in the economy. And I'll talk a bit more about that. Another stream of where your income goes is into paying down the principal on your mortgage. So every month you're getting rent checks, you're paying your mortgage. So that's equity. That's part of your income is going in back to the bank to pay down the debt. And then the other category is appreciation. We'll talk a lot about that because one of the greatest aspects of commercial real estate is you have a lot of levers you can pull to influence the value of your property. All right, so starting with cash flow. So going back to the 2008, 2009, I'm going to tell a little story. Okay, this is the template story for many people and many companies during that period who were involved in real estate. So you have somebody 2002, 2003 starting to buy houses, 2004, and they may even understand the principle of cash flow, right? And the principle specifically is the idea that you have a building, your building has operating costs, and typically you're not paying cash for the building, so you're going to have some kind of mortgage, so you're going to have debt servicing, right? And on top of that, that's your cash flow. Everything that's left over after you've paid your mortgage and you've paid all the operating costs of your building, that's your cash flow. So if everything goes according to plan, that cash flow is dividends in your pocket at the end of the year. If it doesn't go according to plan, that cash flow is your buffer. That's the cushion that's going to absorb higher vacancy, volatility in interest rates, some stuff that breaks down that isn't covered by your tenant's operating costs, right? And so cash flow is really important. And so this is all about, like, the real important lesson here is you have to be careful with leverage. Leverage is a double-edged sword, right? So, typically we're doing a commercial deal where something like 1 to 4 or a little less. Typically we're at 30%, 70% loan to value, right, with an acquisition. And the way I think of that, I think of it like a bridge, right? Because if you need to get from one side of a valley to another side of the valley, one way you could accomplish that is you just fill the valley with rocks. And then that bridge is never going to collapse, right? You'll always be able to get across. Maybe you'll have to fill it in every now and then, but you'll be able to get across that valley. You don't have to worry about windstorms or bombs or anything. You're going to get across. That's a really inefficient use of material, right? So if you actually understand physics and engineering principles, then you can design a bridge that will accomplish the same outcome with much less material, right? And so, but you need to know what you're building for. Are you building a footbridge? Are you building a bridge for 100,000 cars of traffic per day? Are you building a bridge that 10 tanks have to drive over? Are you building a bridge that can withstand a hurricane or an earthquake, right? So you have to define the spec that your bridge needs to be built to, and then you need to know how to design that bridge so it can meet that spec and withstand the risks that could accrue. And so in this analogy, capital is the material, right? When you go into a property, if you're buying a $2 million building and you just write a $2 million check, you're never ever going to have to worry about foreclosure. But but that's really inefficient use of capital. It's really, really hard to make a good return especially in Canada, if you're buying buildings cash. So you want to leverage it, right? Because if you leverage your building, if you have 50% of your building is financed by the bank, then for every dollar profit you're earning, you're basically doubling it because you had to put $1 less in as an investment into the property. So there's a balance there. Just like there's a balance when you're figuring out how much material to put in a bridge, there's a balance that you have to come to when you figure out how much capital you're putting into a commercial asset. And that takes a little bit of expertise, but we're going to get into the most important metrics to consider this. And here's this tale of caution. So 2008, 2009, people may get this principle. They may understand cash flow is important to keep my portfolio sustainable. So they're buying properties, The properties are cash flowing. But then you start to get into territory like 2004 where you're seeing 10% increase in property values, 20% increase in property values. And now it's like, okay, my properties are cash flowing. I've got a house, it's cash flowing $200 a month. I've got a condo, it's cash flowing $150 a month. At the end of the year, I've got $2,400. But that's a $300,000 condo that went up 10% in value. That's $30,000. So if I own 10 of those, that'd be $300,000. You know, I'll never be able to make that kind of profit just off the cash flow. So I need to own more property. Okay, but everybody's thinking the same thing. And so now the prices are going up. So now you're looking around and you know, you're the man or the woman at this point because you've done 20 deals in the last 2 years. So you're getting all the best deals in the market, right? Everybody knows you're a buyer. Everybody knows you're out in the market and you've got capital and you can close on properties. So the realtors are like, hey, they're sending you good deals. And you're probably getting the best deals out there. You're probably 10% below market value because you're so connected and your network is so built up. And so, you know, you're getting good deals. They're still cash flowing. Now they're just starting to break even. You know, even though they're the best deals in the market's so overheated that nothing really cash flows anymore. And so your properties are just breaking even. But now this year, 30% increase in property value. It becomes really difficult. And you know what? You have your portfolio, now you have 50 houses in your portfolio. And overall, the portfolio cash flows still, you know. There's maybe the last 20 you bought are all negative, the first 30 are all positive, so, you know, it kind of balances out. Now your 30% increases in property value each year, now you want more property. And so now you're compromising. You're buying a property that's $200, $300 under negative cash flow each month. Fine, you know. Because at the end of the year, even if your whole portfolio is in negative cash flow, and this is true story, okay? This is true story of at least 6 people, specifically who I know personally, in small single-family residential, and the same version applies to many of the big development companies that crashed in 2008 and 2009, over leverage. And so, yeah, you have your portfolio. Now you're getting to a place where the whole thing is negative. Maybe at the end of the year you're short for 30 grand, right? But no big deal, because you've got 100 houses at this point. You take one house that's gone up in value by 100% since you bought it, refinance it at the bank, pull out $150,000, pay off your $30,000 deficit, you've got $120,000 cash in your pocket, and your whole portfolio has just gone up in value by $30,000, right? So it's really hard. There's so much momentum in that trajectory. But then 1 year, property values don't go up, right? So now you've got $10,000 a month of negative cash flow. Yeah. So if you've got 1 condo or 2 condos that cash flow negative 200, you can figure that out, right? You can cover that deficit from your income from wherever other sources. But if you've got $10,000 a month of negative cash flow, that's hard to just compensate for. And so now all the properties have dropped in value. And you can't cash flow. You're looking for your 10%, $10,000 per month. You bring a property to be refinanced. The bank isn't going to refinance it because they're saying you're already at, now the property value has dropped, so you're already at 60, 70, 80% leverage, right? And in the meantime, you've got if you have 100 properties, there's always going to be a few properties during that year that come up for refinancing, right? Typically you'll do a 3-year term or a 5-year term on your mortgage. So in year 5, you have to go to the bank and they say, hey, I want to renew it. So that's fine, but if they lent you 90% loan to value at the time, and now your property's gone down by 15% in value, now you're at 105% leverage on your property, the bank doesn't want to renew anymore because you're not the only one in this situation. So they had to rebalance their portfolio. So they're saying, we can't renew this mortgage unless you pay it down to the loan to value that our charter requires. So now you've got to come up with 50 grand just to keep that one house. And so, you know, you can't refinance, you've got your negative cash flow, you've got the bank at your heels trying to get capital back out. And so your only option is to sell stuff. But of course, it's the worst possible time to sell anything. And so you're selling, and the only thing anybody's got to even buy is the best properties in your portfolio. So you're looking for the properties that have the most equity and are the most saleable, and you're selling your best gems into the worst market, and that'll buy you 6 months. And in month 7, you're in the same position again, and all you have left is dogs, the worst, crappiest properties in your portfolio that don't cash flow, that are over leveraged, and nobody wants to buy. And you go into bankruptcy. Okay, so that is the cautionary tale, right? That's what happens if you over leverage and you bank on the momentum of a big booming wave economy. which is not uncommon in this province. So, bridges. And this is actually a visual of what it looks like the way we engineer our projects. Okay, so we don't want to sell anything ever. We're always looking at the 5 to 10 year economic horizon in the province to get a sense of the trajectory. But we don't want to sell, especially in commercial real estate. Commercial real estate transaction costs are quite high. Right? We had an apartment in 2015, we didn't buy anything because we knew prices were too high and the market was overheated and the vendors were not properly accounting for the fact that oil had just dropped to $30 a barrel in November of 2014. And so 2015, we didn't buy anything. But we got offers, lots of offers on our properties, unsolicited. And so we had one offer that was just like really hard to resist. We sat down and we did the math. This is why it's powerful to have analytics, especially when you're in a partnership so that everybody can get on the same page. We sat down, we did the math, and we figured out if we sell this apartment building for that price, we're not going to see that price again for two to 3 years probably. But now we're going to pay legal cost to close. We're going to pay income tax on the capital gains on the difference between the purchase price and the sale price. We're going to pay, and now we have a bunch of cash that isn't doing anything. So now we have to go find another property to put that cash into. So now we have to take the time, spend the money in the due diligence, pay the legal costs, pay the broker fees, pay the lender's fees, and all of that. So we did the math on this particular deal, and it added up to $175,000 to trade properties. Right? And the fact is, the same applies more or less with residential properties. It's all smaller, same kind of ratios, all on a smaller scale. A little bit more for commercial, but it's still, the fact is in real estate, transaction costs are quite high. And that is really important to consider when you're thinking about flipping properties and long-term hold versus trying to cash out. So the way this works is when we buy a property, this purple part represents the mortgage, and the blue part represents our cash in, which we do in the form of shareholder loans. We hold every property inside of a corporation. So we all put our shareholder loans in the company. So this is what our cash up is. And this green line represents the property value. Okay. So I'll explain a little bit how commercial property values work. The really neat thing about commercial property is that the value of the property is entirely a function of the income generated by the property. And that's different than residential real estate. I'll explain how that works. But here, this is all a function, this is actually historic, so we're about here right now with this project. And this is all a function of incomes increasing over time. And the neat thing is with commercial real estate, you can actually forecast this with some accuracy because you have 5 and 10 year leases with contracted increments in the lease rates. So like on a 15-year span, something like 40% of that trajectory is actually based on contracted income. So that's really neat. And also in commercial real estate, you do triple net leases, if you know what you're doing. So triple net lease means that the tenant pays property taxes, insurance, property management, utilities, all costs associated with the property other than structural repairs, the tenant is responsible for. So they pay you a base rent, which is basically a guaranteed net income, and then whatever the costs are on top of that, you basically set out a budget at the beginning of the year, and then the tenants pay 1/12 of that budget every month. And at the end of month 12, you do a review of the budget, and if you spent less money than what you had budgeted, you write a check and you send it to your tenants. And if you spend more money than you budgeted, you write an invoice and you send it to your tenants. And so the tenants are responsible for all operating costs, which is really convenient as a property owner because it gives you much more certainty. So this is the neat thing, because we do, in our other businesses, we don't do this because it's useless. Business plans and 15-year forecasts with a tech startup don't work. But they do work with commercial real estate, which is really neat. So this is what the building looked like when we bought it. It was really ugly. Do you guys know Range Road Restaurant? Yeah, so this is like the best restaurant in Edmonton. Number 4 in Canada last year. It's amazing, wonderful. You have to go. You have to go to this restaurant. But you have to book it 2 weeks in advance because they're always full. Where's my? All right. So we're gonna do a bit of math here. So look at this. See this black patch? This is literally a patch of bricks that fell off the wall into the parking lot. And I was gonna bring it. I have this thing in my office that came from when we opened this up, because this thing didn't have any insurance. The building envelope, insulation, The building envelope was drywall, 2x4s, and then like press board with newspaper tarred onto it, and then like tin. That was the entire building envelope. No sawdust, no crumpled up newspaper in the wall, nothing. It was just empty. So that explained why it was so uncomfortable on the second floor. So, let's see here. We have a massive selection of colors to pick from. All right, so this property, when we bought it, it had a net operating income of $120,000. And I am going to explain what net operating income is. So, let's start right here. 120, that's probably too small. 120,000. And then we put in about $500,000 and upgraded the building, new boiler, new electrical, entire new facade. These panels have like LEDs behind them so they light up at night. It's kind of neat. This restaurant expanded, doubled their footprint into a vacant space next door. So we put in about $500,000. And so this is net operating income. So net operating income is basically income minus expenses, but it's different than net profit. It's only operating income minus operating expenses. So it doesn't include debt service. Okay? So it's, imagine you bought the building cash, your income minus your expenses would be your net operating income. So you don't include interest in your expenses when you're calculating NOI. All right? And this is where it gets interesting, because the value of your commercial property is calculated using this very simple formula. So it's your net operating income divided by the prevailing cap rate, and I'm going to explain what that is, gives you what your property value is. So here, this actually gives a bit of perspective. So these are prevailing cap rates for 2016 in Edmonton.